left behind.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. Each and every week we come to you bringing you solutions to the problems that you see out there in the mortgage world as well as in the real estate world. Now, a lot of times they are hand in hand. They can be two different things, especially we have all cash buyers. And as everyone knows who listens to the program, about 25% of purchases out there still are all cash buyers. However, most people are going to get a loan. Most people want to buy a house and want to get a loan. Most people in that category have to comply with whatever standards are out there in terms of getting that loan and getting approved on that loan. Anyway, I am Jeff Barton. If you want to hear and see me, other than today on KCAA in the Inland Empire, hi to everybody out there, you can go to YouTube. Jeff Barton, the Mortgage Voice, is the YouTube show. We also do a Mortgage Minute about once, twice a week. It gives you a daily 5-minute spurt of what we do for an hour here on the weekends, Saturday and Sunday. If you're listening to me right now, thank you very much. I am Jeff Barton. This is the Mortgage Voice. Okay, so as we were just saying, the parameters, the guidelines, what we call, in order to qualify for a mortgage have become tougher in some instances and looser in some others. What do I mean by that? So if you want the best rate possible, which is, of course, the lowest rate possible, you want to make sure that you have all your documents, all the things that you need, starting with your credit score probably above 720, and as everyone knows, the credit score really goes from about 450 all the way up to about 840. So if you're in the 720 and above range, you have the best credit and income. If you want to buy a house, the best way to get the best rate is to put as much money down as you can. Usually that means 20%. So if you've got the perfect credit score or a great credit score, and you've also got 20% down, and then you can also, coupled with all that, prove that you can pay that mortgage and you are a W-2 employee and that employment is expected for the next 30 years, and there are no hiccups on your credit report, no lates on your mortgage or your rent payments that you've had over the last 24 months, all things being equal, you're going to get the best rate. But most people aren't like that. Most people live and have, issues from time to time, whether it be in income that gets interrupted, or switching of a job, or going from 1099 to W-2 or W-2 to 1099, or they have a credit issue, i.e. somebody got sick in the family and you had to stay home to take care of them, so you had a 3-month gap on your employment, or you just got behind on your payment because the money you want to use to pay the mortgage or pay the rent had to go to medical bills. All of these things are normal. Everybody who goes through these things will say, hey, look, I wanted to pay, or I didn't want that to happen. And yeah, I understand that. But do lenders not take advantage of the fact that those things happen? Yes, they do. So borrowers such as that end up going to places like FHA. FHA is less restrictive on credit, i.e. something happened in your world that made these things more difficult for you to do and you missed some payments. So FHA, and they go down to 480 in the FICO score. Now, we were talking A-paper best rate at 720. This is also a pretty good rate with FHA. But with FHA, you have to pay mortgage insurance. Mortgage insurance is an upfront fee of about 1.25 points, or 1.25% of the total amount of the loan. And it's about, I think it's quite close to that on a yearly basis divided by 12. So you're paying for this insurance. Now, can you get out of the insurance? You have to petition or ask once you have 20% equity in the property. See, the thing with people who have credit challenges, according to lenders, yeah, they'll understand, but to a point. They want to make sure you got skin in the game. Anybody who hasn't had a gambling problem, that means you got to have some equity in your home in order to make sure that you don't stop paying on your mortgage. Equity in your home is good news to any lender that wants to lend you money, because nobody's going to give up 20% equity in a $500,000 home. That's $100,000, i.e. if you got foreclosed on. That's right. Now, granted, you get foreclosed on and they sell the property, they have to give you the proceeds, but there are fees, there are lawyer fees, there are late fees, and that $100,000 equity that you think you have turns out to be $50,000 or $40,000. So nobody wants to lose equity. That's why equity in your property, equity is a good thing, which will mean that they'll lend you the money. That's really what that means. So if you want the best rate, it's the first scenario. If you want to get into the property on a good rate with some credit issues, FHA is the way to go, but it's going to eventually cost you more money because of the mortgage insurance premium, which you don't get back. Now, there are stipulations on that, but for the most part, that's the break we have. So let's get right to what the real rate is today. And for the 30-year fixed rate is 6.42, 15 years 5.52. And let's see what else. The FHA is at 5.87, 6.0 for the 30-year jumbo, and 6.65 for the 5/1 ARM. The 10-year is at 3.64%, and the 2-year is at 4.45. There's still a huge spread between the two, almost a point, 85 basis points. And that, okay. We've been predicting, because of this spread, for a year, and we probably had the spread 6, 7 months, maybe 8 months, because it has in the past. If you have a spread between the 10 and the 2, which they call inverted, i.e. usually the 10 is more, the 2 is less, but now it's inverted, i.e. the yields, you will get a recession. And this is, pretty standard stuff when it comes to economy and the economics of recessions. Well, in this case, it may not happen. Now, I've been saying even last week, hey, we're going to get a small recession, a limited recession probably in late Q2, early Q3. I still think that's going to happen. I think the rosy picture painted by a lot of economists, or starting to paint for the economy, is not necessarily the same thing that I saw 2 weeks ago when I saw most economists saying, hey, look, it looks like we're going to get some layoffs. It looks like we're going to have a recession. And partial the reason for that, it's the same reason why inflation is diving or dropping, is because we have had the Fed raise rates from what they were, which was 25 basis points to 50 basis points, all the way up to 4.5 to 4.75%. Now, this is the Fed funds rate, right? This is not mortgage interest rates. There is a tangential relationship, but it is not the same. So the Fed funds rate, that's going to affect you with your car loan, for instance, or your credit card bill, or other short-term revolving debt, because that's exactly what that rate affects. In the banking world, if you're a banker, you got to keep a certain liquid amount in your vault, let's say, or in your accounts. If you don't have that by the end of the day, you got to borrow the money in order to meet the liquidity requirements by the CFPB. So they borrow the money back and forth. Well, that's the rate that the Fed has been raising. So if you have a rate that was 25 basis points or a quarter point, and you raise it up to 4.5 points, well, guess what? That overnight rate is huge and high, and therefore the money that's required in order to borrow that, i.e. it's obviously a lot more if you're talking billions of dollars on a daily basis, you're not going to have as much money to lend out into the community. And that's what they call sopping up the excess in the market so that there's less money to lend to you. And therefore, by driving up the short-term interest rate of the Fed, it's going to affect the inflation because it's going to make people realize that they don't want to pay more on their credit cards, they don't want to pay more on their car loan. They're going to look around and see, hey, maybe it's a good time not to spend money. And that of course, in the supply-demand chain says, hey, if I've got too much supply, obviously it's going to cost less. That is a scenario that's out there and has been out there, and I have subscribed to. Now, I've got a number of things that I'm going to bring up in the next section that'll talk about what's happening now as a result of this huge job report, 517,000 new jobs created, and that is a number that we haven't seen in quite some time. Like when? Think about that. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Appreciate you listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening. And if you listen each and every week, you know that we try to provide you answers to, those burning questions like, will the rates come down? Are we going to have a soft landing, whatever the heck that means in the economy and the recession? And is it going to happen? Jobs report's kind of crazy. What does that actually mean? A lot of these things are, yes, they're important, but they don't necessarily mean anything if you're out there right now banging on doors looking for a house to buy. If there's nothing to buy, what difference does it make if the economy's up or down and you can't afford a mortgage? So answering some of those questions we try to do, but we also bring to the show guests, people who really know what's going on because their feet are on the ground and they're out there, beating a path to the next buyer, the next seller, trying to figure out, how they can help and solutions to problems that are out there in the marketplace. Luke Mankey joins me right now. He's from Malibu Funding. Been on the show many times. Luke, how are you?
I'm good, Jeff. Thanks for having me back on again.
Don't say it like that. It's not a drudgery. This is probably the highlight of your week. I know that.
It is.
Okay, so no, I understand the sentiment because it's rough out there in our industry, and we've seen countless number of lenders and loan officers not only complaining but going out of business. How are you faring, and then what is the demand in the marketplace right now that you're seeing?
I'm feeling good, feeling optimistic. If you've been doing it long enough, you've seen the highs and the lows, and us persevering and coming out of those lows, and here we are again. And how much longer it'll take, nobody really knows. But I'm stubborn, and we're going to come out of this. I myself, I could be an outlier, but I have been pre-approving and working with a ton of people. I've probably got over 20 clients that I've been pre-approving over the past 6-8 months, and they're just not finding the right place. They want to hold off. It's a whole slew of things. It's not all just interest rates. You kind of alluded to it a minute or two ago on the intro, which is, inventory or the right inventory.
Right.
You got a decent place that's priced right, they're selling very quickly. And then if you've got, a pig with lipstick on it and you're trying to still get high prices for it, it's sitting. And those are the sellers that it's kind of frustrating to deal with. But I know this is all going to click here it has to at some point, and then we're all going to be up to our necks in business again, at least in the purchase sector. Refinance, not so much. But I myself feel optimistic, and I'm sure the second half of this year is probably going to pick up. That's kind of thinking, but who knows? I could be wrong.
So, okay, you're talking about 20 different buyers over the last 6 or 7 months that you're sending out pre-approval letters with and trying to get them qualified. And you mentioned a number of the different issues that they have that are separate than the mortgage interest. You're talking about the economy, you're talking about the right house, you're talking about the right neighborhood. All these things are considerations, but the hotness within the real estate market just doesn't seem to be there, at least with the clients you're talking to. Is that right?
Yeah. Yes, that's correct. And I don't know. And investors, most of the investors I've worked with and they all want to sit back and wait a little bit longer and see, what shakes out. Wait for this inventory of distressed sales and whatever, and how much is going to come. Again, nobody really knows. But I think a lot of the first time or just primary residence buyers, there's still a ton of interest out there. Investors seem to be a little bit more calculated in finding the right deal or waiting for prices to drop a little bit more. They're not quite as concerned on interest rates so much as just wanting to get lower values off of who knows what.
Well, that's a completely different game with investors because they usually have cash to put into these kind of deals, or they're looking for specific price ranges and margins before they jump, and they want to make sure that the bottom of the real estate market is already hit before they jump in, or just about to hit, right? Everybody's trying to do the timing that makes things right. But let's say you've got a customer who is, qualified at a certain price point, but that price point keeps moving, so they're not real anxious to jump into the market either.
Yeah, you're right. That's one of the things that makes it difficult right now,
Right.
of course. And what these interest rates are doing to the payments, there's all that. I mean, we're always juggling so many things, right?
Yep.
Just to get a buyer, to then get that buyer in escrow and deal with the sellers, and then get that loan and navigate all of the landmines. And now, you got all this other additional uncertainty it was nice with interest rates being down all of January largely.
Yep,
that was great.
they were.
And then they spiked up this week. And
what is that?
now
Why is that? Okay, that's a good point you bring up, because I noticed it, not only noticed it, our building falls off a cliff when it goes up by a quarter point. Well, it went up about a half a point this week, and you're like, why? Why did it go up? What was the big deal?
Yeah. No, I know.
But
right.
You and I follow it, and I can talk about the 10-year and the 2-year, and I can talk about the inflation problem, and I can talk about a lot of things. But, when it comes right down to it, lenders raise rates because the risk got higher. So I'm thinking, what risk? They just hired 517,000 people last month. Where's the risk? Anybody?
No, crickets for me. I don't know.
Right.
It obviously this last drop, January's drop in rates was after the Fed raised the benchmark again. But
right.
I kind of feel like and I don't know. I guess it makes a little bit of sense if he's going to raise the benchmark one more time, then maybe they're anticipating that, and that's why they raised. I'm not sure. Another thing that was kind of driving me nuts, and this is a bit of a pivot, but today and last week as well, looking for ARMs that were, all right, well, okay, I'll pay these prices, but can we get the payments a little bit lower? Let's do an interest-only ARM. God, the ARMs are the same rate as the 30-year fixed.
Yep.
So it makes no sense to put somebody in an ARM and an adjustable.
Nope.
Why would you do that? It's foolish. If the rate's 6% on a 30-year and 6% on a 5-year ARM, you're a fool to take that.
Isn't that a scare from 2008, though, when all those pick-a-pay and ARM programs, came due 2-3 years later, and, the market had already crashed, so everybody just walked? Isn't that what that is? Because people aren't quite sure what's happening with the economy?
Agreed. Yep. It makes sense. I get it.
Right.
I get it. I just also put a 0.5% or something. It's got to be a 0.5 to 1% different. But yeah, if they don't want it, they don't want it. I guess that's their
right.
pricing.
That's how they deal with it. We don't want this product. So who's going to? Right.
Yeah.
You've got actually the 30-year cheaper than the 5-1 ARM. So,
Yeah.
Okay, so let's talk programs a little
Why
bit.
we drink?
No, that's very funny. So let's talk programs a little bit. Some of the popularity of the 30-year, maybe not as what it was. Do you see the 15-year being attractive, like we were talking about FHA a little bit, jumbo? What are you looking at?
I'll be honest with you. I haven't priced a 15-year in many, many months. So
okay.
I am not one to comment on that. I haven't had anyone just because. But yeah, for me, most of my buyers are they're just, it's either first time or
right.
Whatever. It's maybe their second or third home, but they don't have. Prices are high, rates are high, so they're not trying to increase their payment because they want as much buying power as possible to get them into something.
Right.
So I haven't looked at those. FHA is pricing nicely. I again focused more on the 30-year.
Right.
The non-QM sector is kind of difficult. Put a lot of work into it. The products are there. They're great. They're amazing. But my gosh, the rates are 8 to 9%. That's another difficult one to sell. And so.
Well, right. I mean, if you're like you said, there are great programs. It's expensive.
Yeah.
In any market, 9% is 9%. That's no joke.
We got to live in this for a little while longer.
Yep, I agree.
Yeah, I wouldn't accept it either if I was the buyer. I'd be like, all right, it's been crappy for 8 to 12 months. If it's still like this in another 6 to 12, okay, I guess I'll accept it. But
Right.
yeah, I don't know.
Hey, Luke, we're up against it. I wanted to thank you for coming on the show. I mean, it's a tough time to come on as a loan officer because what you're talking about is, how difficult it is to help your clients. But in the reality of it, there are programs and ways that you can go. It's just expensive, and that's a tough way to go. But I wanted to give you an opportunity to tell people how to get in touch with you. You're, one of the best loan officers over there at Malibu Funding, and want to get you a chance to get some business going.
Thank you, Jeff.
Sure.
Yeah, you can get a hold of me. My cell is 818-209-2592, and email is luke.malibufunding@yahoo.com.
Luke, thanks very much for coming on the show. I know we didn't solve anything, but we certainly had a good time talking about it.
That's what it's about right now. We're doing the groundwork.
Yeah, exactly right. Thanks, Luke. I appreciate it very much. That's Luke Mackey from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry.
You're listening
We'll be right
to
back.
The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in once again to hear the show. If you hear it the whole way through, you get a whole bunch of perspective, both on national as well as local things. We are at KCAA here in Southern California, as well as on the internet. You can see us. YouTube is one of the many places you can see us. We do a mortgage minute about once, twice a week. You can see that on Instagram, YouTube, Facebook, any number of other Instagram, LinkedIn. And by the way, what happened to LinkedIn?
It fell flat. I had no idea.
Oh my gosh! You go on that, you're looking for business solutions and things, and man, it's a mix of everything from Facebook oddities to Instagram promotions. I don't know. It just turned weird to me.
It became a relic all of a sudden.
I don't know. Anyway, bringing to the show once again another person from the lending world, somebody who has way more answers, especially on programs and solutions for borrowers, is Tim Wise from The Lender. Been on the show before. He joins us now. Tim, how are you?
I'm doing well, sir. How are you?
I'm fine, thank you. Sorry about that sidetrack into LinkedIn. It's just sometimes you go to these, what you think is one thing, and it turns out to be something else. And not the bait and switch that we used to do or hear about doing in the lending world, which is a no-no, obviously. But how are you? And you're saying you're well. Tell us a little bit about what's going on from your perspective in the lending world, some of the solutions you might see out there from the lender.
Well, on that one subject of LinkedIn, first of all, it's turned into just a social media frenzy of mix between Facebook and Instagram, and it's not really just the business world anymore. It's turned into people's personal lives again.
Right.
So that's that. I don't have a huge presence on LinkedIn just for that reason. I'm on there and I have followers, and I'll follow some people, and I'll follow my company and things, but that's about it. You don't get too much business done on LinkedIn anymore. No,
and it like all these things gets polluted just because people think they can do whatever they want. So yes, I suppose they can, but doesn't mean I have to go there anymore.
Back to why you brought me here. I'm excited to talk about two of the programs that we do most. One is called the NADA. The reason we call it NADA is because it's 100% financing. It's an FHA program, but there's no money down from the borrower. It's actually two loans that get done, but it's not a DPA program. We lend the second mortgage of that 3.5% down payment. So it's a traditional first mortgage of an FHA. We're going to lend that 3.5% down payment to the borrower over a 10-year period. They'll pay that back, and there's 100% financing in there. So it's a really popular program right now that's just in time for the purchase season to hit. And brokers, the rates and pricing have come back with that as well.
Right.
So we're affordable for the borrower. I think it's going to be a really strong program come March and when purchase season.
I love FHA right now because it is the lowest price property just on its face, and you add in the fact that you're not going to charge them for the down payment. How does that actually work in terms of you're doing a purchase rather than a refi? Is this purchase only or is it refi too?
Yes. No, this is for purchase only.
Right.
And because we're just providing that extra that down payment, which is that 3.5% required down from FHA. So when a broker submits that loan to us, it's just one loan that they submit to us.
I see.
But we'll that mortgage with it, and it links with the first mortgage and follows it the whole way through. So the broker will just work the first mortgage. Once that loan is clear to close, the second mortgage is clear to close with it. We'll send 2 closing packages to the closing table for the borrower to sign.
No, that's excellent. Now, do you have a blended rate? How does the first? The first I understand. The second is.
Yeah. So how that works is whatever the first mortgage rate is, the second mortgage is 2% higher. So if the first mortgage rate is 5.5, the second mortgage rate is going to be 7.5.
Okay, and usually, like you say, 3.5%. So the payment is not going to increase all that much. It's just the rate sounds. No, right, exactly. So yeah, this is going to be a very exciting program, just because solutions-wise, you're allowing people, and do you conform obviously to the county, whatever the conforming limits are to those particular counties that you're doing again?
Correct. So there's no restrictions on the loan limits. So we go by whatever FHA's loan limits are. High balances accepted as well in that.
Okay.
No income limits. So you know how traditional DPA programs will have income limits, geographical restrictions, anything like that. We don't have those with this program. So it's an alternative to any other type of DPAs where they may not fall into what they may approve. They're going to get approved for this. If they get approved for an FHA loan, they're going to get approved for the second mortgage.
So interestingly, the way I read this is that your company thinks that the real estate market is still going to be strong. The prices are still going to continue to climb. Otherwise, it wouldn't make any sense lending on properties that would be going down in price, right? So you're really bullish on the real estate market.
We feel that we've hit the bottom.
Okay.
And that we are in a period where we are just in a flat line.
Okay.
So, and this could be different depending on what area of the nation it is, but there's going to be some pockets of nations that may still be in a declining market. But we feel overall the nation is at its stagnant period and out of the decline. And rates, with the Fed's only raising the interest rate a quarter, their last meeting,
right?
We think it's going to even itself out. On the broker side, we feel that the borrowers, they're not in rate shock anymore. They're not calling the brokers and applying for that loan and expecting them to quote a 3 or 4% interest rate anymore. They've realized that they're not going to get that, and that's not where the market's at. So over last year when all that was happening, that hurt a lot. And also FHA, those type of borrowers, when they were trying to purchase homes over the last years, they were getting squeezed out. If there were 5 contracts on the table, the FHA borrowers were the first ones getting thrown out. They were conventional buyers. So those FHA buyers, they got squeezed out of the market and weren't able to purchase over the past couple of years. They're still there. They're still renting. They still want to get into a home. I think it's a great time. It's going to be just a great it's almost like the perfect storm, so to speak, for new buyers and FHA buyers to come into this market right now at this time and purchase a house.
Now, the show reaches a number of different markets, but one in particular, KCAA out here in the Inland Empire, which is just east of Los Angeles and Riverside and San Bernardino and counties out there in the Inland Empire, you must see that there is a reserve or a pocket of FHA buyers within this community, right?
Absolutely.
And they're conforming limits, whether they're 625 or 528 or whatever it is right now. I'm not even quite sure what they are. But
it's actually gone up to 725.
Okay.
I think is worth. So, but FHA has also raised theirs as well, and there's high limits. The high balance limits are accepted for this program also. So any of those areas that are high balance like that are going to be able to do FHA with the higher loan limits.
So you deal with brokers or you deal direct, either way that you do it, getting the message out to borrowers about the 100% program, that's a big deal. Obviously, that's one of the reasons you're on the air today, so that we can spread the word about what you're doing. And also, the companies that you're working with, Malibu Funding being the sponsor of the program is one of them. And so what else can you do in order to, like I say, spread the good word? This is pretty good. This is a pretty good program. Good solution here.
program. Our customers are mortgage brokers. So if you are a customer or a realtor listening to the show, you can contact one of your local mortgage brokers. They have access to us and can do your loan through us.
Okay, so that's that, and that too is a very good way by which you can also spread not only the word but the wealth, because as you well know, and we had on an earlier segment a couple of loan officers that were talking really about the difficulty of being able to pre-approve somebody in a market that's difficult. You're not quite sure whether it's a recession. You're not quite sure whether, interest rates are going to go up. You're not quite sure what the Fed's going to do, whether inflation, all these competing things for your attention really draws you away from the home buying process. But a program like this at 100% brings you back to focus in on what you can do. I like that.
Absolutely.
Listen, we're up against it, unfortunately. I appreciate it again coming on the show. It's a very good program. If you wanted to shout out your name and number in case people wanted to talk to you, otherwise, thank you very much.
Yes. Again, my name is Tim Wise, Area Sales Manager with The Lender. And you can reach me at tim.wise@thelender.com.
Excellent. Tim, thank you very much for coming on. Good solutions, and I appreciate the time you spent with us.
Thank you so much for having me. Thank you.
Thank you. Tim Wise from The Lender. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. If you want to see the show, go to YouTube, Jeff Barton, the Mortgage Voice. We've been on there, hundreds of shows on there. You can see past shows that talk about the trends and what's happening in the mortgage industry as well as the economy. Or you can tune into today's show and we can talk to you about, what's happening locally at the KCAA market, Southern California. Certainly all these things can affect you and your decisions about how you're going to go about getting your mortgage. What do you want to do if you get a house you want and you're trying to figure out the best program available to you, and you want to do it quick, because if there is competition, and that's the other thing we have to worry about, competition in the marketplace, you want to be all ready to go. And in order to do that, you got to find yourself not only the program, but really a mortgage broker, somebody who can help you, walk you through a lot of different scenarios. And to do that today, we brought on Bill Orr, who's been with Malibu Funding for a number of years. Great guy, very knowledgeable, and has really been in the business of helping people, solutions in the mortgage industry for, like I say, at least 10 to 15 years that I know him, and probably longer than that. He joins us now. Bill, how are you?
I'm great, Jeff. Thank you so much for the kind introduction.
Oh, thank you, Bill. You're a great loan officer and always come to us with information that is possibly not well known out there. Usually we talk about programs. I think today you're going to come on and talk about a number of different processes and what's happening with the different types of programs, give people some options.
Yes, that's correct. Yeah, so when you go to buy a house, and I want to kind of touch on something you said, Jeff, actually right there in the introduction. When you buy a house, you may have heard people talk about being pre-qualified or pre-approved, and that is certainly an integral part in the home buying process. Basically what that does is it gives you, if you're buying a home, and the real estate agent that you're working with, an idea as to how much of a home you're qualified to buy. $350,000 condo, or a $500,000 or $700,000 single-family residence, or above that, depending on your economic situation. And we pre-approve you, and then you're out shopping. But what I try to do for my clients, because it is so competitive out there, I try to take it to the next step, which is to actually issue a full loan approval. Now, here's why that's important. Because when you're out there looking at open houses with your real estate agent, you may be walking up the driveway to take a look at the house, along with 2 or 3 other families, as well as 2 or 3 other families are just leaving the house. In other words, there's a lot of competition out there. And if you find a house that you like, having worked with homeowners or home buyers for, actually this year, I'm beginning my 27th year in the industry.
There you go. Good.
Yeah, it can be very frustrating. You see a house, you love it, you're laying awake at night thinking about what color you're going to paint the bedroom, and you get beat out. Somebody buys the house from right underneath you. And one of the ways we can do to help you actually get the house that you want is by being fully approved. I then have a conversation with the listing agent and say, this is not a pre-qualification, this is not a pre-approval. The underwriters actually approve this loan ahead of time. All we need is your property appraisal, and we're ready to close. That is a huge step up from the competition. So if you are actually in the home buying process right now, I'm going to encourage you to contact me or contact Jeff. We'll give out numbers at the end of the broadcast here about how to separate yourself from the other home shoppers out there to be a fully approved all cash buyer.
That's excellent. And you know what? A lot of buyers don't really understand the difference between a pre-approval, an approval, a full approval, a DU approval.
Right.
It's just all confusing to them. So they really need to find somebody they can trust in the process, that they can also say, hey, selling agent, listing agent, call the guy, and then have the guy be not only on the phone, but being able to educate and compare what you've got to whatever the competition's bringing in that particular offer.
Exactly, we're not. It'll be beyond the scope to go through all the details right now on this radio show. But when I speak one-on-one with the client, I go through in great detail to make sure they understand the importance of being fully approved, and whether it be pre-approved or fully approved. We go through in great detail to make sure that you, as a home buyer, understand what that is.
That's very good information. Now, there are many programs out there, but we generally talk about, especially with, in competition, whether you're going to be a 30-year fixed rate loan, whether you're going to be, some other variant in the year, 15-year, maybe 20, 40-year, whatever it is. There are FHA products. There's certainly non-QM. So when you're talking to your borrowers about which program, how do you explain the differences between, just pick a couple of them. Let's say you've got an FHA product or 30-year fixed.
Great. Okay, well, right. So the issue, if we want to compare FHA versus 30-year fixed, you may have heard the term conventional financing.
Right.
That usually means two other names you've probably heard of over the years, called Fannie Mae or Freddie Mac. So on the conventional side, it's usually insured by Fannie Mae or Freddie Mac or FHA. Those are both all considered conventional financing. The key difference is FHA, when people talk about first-time buyer programs, it's usually FHA is what they're talking about, because that allows you to buy a home with only 3.5% down payment. How do you calculate that? If you're driving out looking at houses or looking at homes online, get your cell phone out, get your calculator, and you multiply the purchase price times 0.035. The purchase price times 0.035. That will tell you what your down payment will be, 3.5% down payment. Then as you get into larger down payments, sometimes it makes more sense to go with conventional financing, and that usually has to do with mortgage insurance. If you have a larger down payment, maybe 10% down payment, or 15 or 20 or more, then FHA may not be the best option for you, having to do with mortgage insurance and how you can get rid of it, that kind of a thing. And I do hear that a lot. Oh, I don't want to pay mortgage insurance. I'm like, well, let me tell you something. Paying mortgage insurance is a great way to go, instead of sitting on the sidelines and not buying because you want to pay mortgage insurance. And here's why. Let's say you buy a house right now for $700,000 or $600,000, and you're going to buy that house, and in the time it's going to take somebody else to save 20% down payment, your $600,000 house is now worth $750,000.
Right.
Now, the person who didn't buy and chose to wait on the sideline, they're now going to pay $750,000 for a house that you paid $600,000 for.
Right.
So, because you can't, in rare exceptions, like if you win the lottery, that's great. But chances are you're not going to win the lottery, and most people have to save up a little bit every time. We all know how difficult it is to save $5,000, $10,000. So you want to get into a house as soon as humanly possible, so you can let the economy and property appreciation help you along the way, and that's how you build long-term financial stability for your family. Buy as soon as you can get in the house.
I love that. And I love that way you look at that. And I just wanted to interrupt you just quickly to say, most people don't look at it like that, because they see, oh no, I don't want to pay, and to continue paying. Well, you can get, with appreciation also comes 20% sooner than you would have to, let's say, save up that 20% or whatever it is not to have mortgage insurance. So I agree with you. Get into the house. Yep.
That's right. So now when we talk about the different loan programs, from my perspective, it usually has to do with income. So let's assume for a second that you have adequate credit, usually a credit score of above 680 or even 650 in some cases, 640. But most people, when they're looking to buy a house, it's usually 680, 700, 720, 740, that kind of a thing. If your credit score is good, so we're going to assume you have a decent enough credit to buy a house, and let's assume for a second that you've saved up your 5%, 10%, 20% down, whatever it is, and you're ready to buy a house. The next question is, Jeff threw out the phrase non-QM. What that means is non-qualified mortgage. So that would be the type of loan where, for whatever reason, you can't document your income. So, for example, maybe you're self-employed. Maybe you're a sales rep. Maybe you have a commission job. So the type of money that you do a lot of write-offs. I mean, big shocker, not everybody's 100% honest on their tax returns. so if you have somebody who maybe doesn't claim all their income, self-employed people, business owners, or maybe people who take a lot of write-offs on their business, their tax returns don't really show how much they really make, because maybe they're getting together with their CPA at the end of the year and they're being very creative. So if they really do make enough money in real life to buy that $600,000 or $700,000 house, but their tax returns tell a different story, that you're only qualified to buy a $300,000 house, the next way to do that is by using one of these non-QM programs, which is a fancy way of saying we have other ways to document your income.
Right.
Maybe
hey, Bill, we're up against the clock here in about 30 seconds, so yeah, just...
Okay, so there's other ways to document your income, and that would be a great opportunity. So if you have income, but maybe your tax returns don't show it that way, that's time to call a loan officer. Let me give you my information while we have it. So
please do.
My name is Bill, and my last name is Orr, O-R-R, Bill Orr, and my phone number is 818-406-4744. Again, 818-406-4744, and I work with Jeff at Malibu Funding.
Bill, thank you very much. I'm sorry to cut you off like that. It's just I was listening to what you said, looked up, and then the clock stared right at me. So
Understood.
Thanks very much for coming on the show, Bill. I really appreciate it.
As always, Jeff, I really appreciate the opportunity. Thank you so much.
Absolutely. Bill Orr from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hi, I'm Jeff Barton. I'm your voice in the mortgage industry. Just talking to Daryl off air here. We have a very interesting show off air, and sometimes maybe we'll give you a brief view of all that. Again, I'm Jeff Barton. This is the Mortgage Voice. We are on a number of different stations. One of the greatest stations we're on is KCAA in the Inland Empire, and we appreciate everything they do over there. Fred, Mark, all the people that put us on air, and also give access to a great many podcasts. Daryl, do you have a list of those podcasts?
I sure do, Jeff.
Great.
It's Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
Excellent. Podclips.io. I always promote those people because they have a central place you can go to get any number of different podcasts. It's new, they're hungry, they want to be able to share with you with either finance or lifestyle or health, or as this is in the financial world with mortgages. They just got a lot of good things that you can listen to all at one place. That's podclips.io. I'm Jeff Barton. This is the Mortgage Voice, and you can see me here on YouTube. You can go to our website, which is themortgagevoice.com. Lots of different places that you can find us. We do the Daily Mortgage Minute, and that's on LinkedIn, Facebook, Instagram. Although I don't do Twitter anymore, I just can't stand that guy. So I don't know why that just hit me right there. But, man, it's just anybody who has that much arrogance and that much money can't be good for anything. Although good for him, I guess he did it all on his own, plus his father's $100 million I think he backed him with. Anyway, I'm not bitter at all. I got what's the all he left me was a loan. Yeah, that's me and my inheritance. Anyway, let's get right to it. I talked earlier in a segment about the jobs report. 517,000 jobs, new jobs in January alone. Kind of an astounding number. Took people by surprise. Knocked some economists over. Larry Summers was so befuddled by the whole thing that he said several times during the interview, and by the way, if you want to see Larry Summers, he was instrumental in a couple of administrations, one of them being the Obama administration, and then earlier in the Clinton administration. He's just astounded by the fact, and then fell back on previously what he thought. Everybody thinks this is an outlier, this kind of information, this job information that's out there. Oh, it's not really what it is. It's an adjustment. It's a thing. And so this, 517,000 jobs, that's big. That signals what to the Fed? It usually signals that, hey, we can keep raising interest rates because the labor market is so strong. Is it strong? I think it is. There's still 10 million jobs out there waiting to be filled. Anybody who can't work should be working. Brings up a number of different issues, and I want to go through them. So let's go to the news to use section. Hourly wages up 0.3% for the month of January. That equals 0.3%, about 3.5%, 4% for the year. The Fed raises by 25 basis points, and we talked about that a little bit earlier in the show. And probably 2 more times they're going to do exactly that. They're going to then wait and see what happens with inflation before they actually turn to either lowering rates, which everybody wants them to do is in the stock market, or raising rates, everybody who wants to buy eggs. That's what they want to do, raise the rates so the price of eggs comes down. There's an interesting quote here by economist Steve Bell. The economy isn't booming, although it clearly isn't on the verge of a recession either. So my predictions of late Q2 or early Q3 as a recession is still, I think, is still pretty valid. Although we'll see, we'll have to have, a regrouping as we always have, and I've done that several times. A year ago, right now, we were talking about how rates were going to rise. They did rise, but we didn't know they were going to rise. The mortgage interest rates we're talking about from 3% to 7%, but that's what happened last year. A different story, different time. We need more people in the labor force, right? Everybody knows that. One of the reasons is we have 10 million unfulfilled jobs. 2 things about that. Immigration. Now, we talked about immigration so often in politics as a negative thing. Immigration in certain states like California is probably a good thing. Somebody's got to do the work that obviously we don't have enough workers to do. There are plenty of jobs in those fields, even though tech may not be the best option for a lot of people right now because there are layoffs in tech. But agriculture, absolutely. Labor, day labor, anything that has to do with service sector, all of these types of jobs, restaurants, bars, even people at Walmart and Amazon, warehouse work, all of the what they would call the more manual labor type jobs, which are paying better. They're not paying great, but they are paying better than they were 3-4 years ago. Those are the types of jobs we need. And can we fill them with our current labor force? No, we can't. So the other thing is tech solutions. Either we get more people or we figure out tech solutions. So what does tech solutions mean? Well, I looked up about what exactly, other than robots carrying the boxes around, other than self-driving cars, these are technological solutions to get rid of workers or fill jobs that workers aren't there to fill. That's a better way to look at it, especially in an economy like this where we have all these jobs and nobody can fill them, right? So in an article I read on MarketWatch, MarketWatch is another great place where you can go. You have to subscribe, but it's still a great place that you can really keep up on what is latest and greatest. In the MarketWatch, technologies, next 20 years, there's 4 of them that they point out, and these 4 can all aid in terms of, needing employees. One of them is commercial space exploration. Now, a lot of what we do currently is to send up manned projects to be able to do whatever they're doing up there. Commercial space exploration would be more robotic, would be more manless. It would be more search for minerals and a way by which to augment on-Earth industries. As we all know, lithium here has gone through the roof, and ecologically it's one of the worst things you can do to the planet. It's open mining, which means you get the biggest equipment possible and keep digging holes until you find enough lithium to be able to really supply the batteries that we need. All these lithium-ion batteries, where do you think that lithium's coming from? Well, it's only coming from 2 or 3 places on Earth, and they're really strip mining the heck out of these places. So in order to be able to take advantage of non-polluting, non-climate changing transportation, you have to find ways to get these technologies that we need up and running and to mine off-Earth sites. That's the goal here, right? Okay, so that's one thing that they're trying to do. Green hydrogen, another one. This technology in terms of drilling, ore drilling, whether it's for oil, whether it's for lithium, as I just said, whether it's for other minerals and the depository items that are used in the production of either oil itself for gasoline or lithium ion for batteries. Green hydrogen, what is it? Does anybody know what green hydrogen is? Yes, I do. It's something you can derive from any number of sources in order to be able to do it from water, which is one of the cleanest sources, and to be able to produce it in a mass way so that those particular jobs that we are currently doing will not be needed to be filled, is extracting hydrogen from water. It's currently very expensive, but in the next 10, 20 years, it won't be. That's one of the green jobs. Another one, and this sounds more financial than it is anything else, private equity secondary market. What does that mean? Okay, so if you have somebody that is trying to invest in a company that will one day go public, they call it angel rounds. That's the first initial stage of funding for any company. And then they call it first round, second round, blah, blah, blah. Before you go public, there are millions of shares offered. But currently, there is no marketplace prior to going public. So what happens to the investor in those situations if they want to get in and get out? They can't, because they're in until the company goes public. They're going to develop a market whereby those securities prior to going public can be traded. Now, how does this help in employment? How does this help? Because the movement of money and the freezing of money is the way by which those particular assets are not used to their highest and greatest ability. In real estate, we call that the highest and best use. So what is the highest and best use for your money? The more it's freed up, the marketplace will determine. And that's a good place whereby employment as well as employees, as well as employers, will be able to use that money in a more efficient way. And the last one, of course, is generate AI, artificial intelligence. Everybody has seen iRobot, right? Everybody has seen the scary prognostications of what's happening with artificial intelligence. But when you're talking to somebody online and you can find an artificial intelligent bot to be able to actually talk to you like a human being, answer your problems, and won't mind if you're screaming at them, now that's something we could all use. Improved customer service to any business will depend 100% on AI, and those jobs will not be generated. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
A journey of 1,000 words begins here.